Hey, welcome to the show. I have a special guest joining me today, Deon Bakkes. He is working on our model valuation team and is here to present a model that he built to look at the price of XRP in a couple of different situations and scenarios. Welcome, Deon. How are you doing today?
Hey, Molly, I'm doing great. Thanks for having me on the show.
Yes, so excited for you to share what you've built. It blew us all away when you first showed it to us. So I know the broader community is going to be pretty excited. So before we get into the model that you built, can you just give us a quick recap on your background and why sort of building something like this was of interest to you?
Yeah, so I'm a scientist. My background is in evolutionary biology and ecology and that kind of thing. I've been working in scientific research for like the last 6 years, publishing papers, and obtained my PhD in 2021. So I love this kind of mathematical models, especially because there's a lot of commonalities between economics and ecology, actually. I mean, they share the same beginning of the word eco, which actually refers to, I think it's the Greek word for it's oikos, which refers to house or kind of like system. It's all about how things move and cycle through systems. So my mind is definitely geared in that. I mean, I grew up in South Africa as well. So I grew up around nature, watching all these various processes flow in and out. A lot of ecology is really about how resources move, and that's kind of what the ledger is about too. So the second I discovered the XRP ledger a couple of years ago, I got this feeling, this sense that there's something very interesting here, and I just want to be able to understand it deeper. And I've been trying to think about how to conceptualize what flow means, what price means in this whole system. So that's really what attracted me to wanting to build something to explain how the ledger works better.
You then discovered that we were building some various forecast models for XRP. And did that sort of spark you to build your own?
Yes, no, actually, I mean, that's one of I'm really glad that you guys put together the valuation committee because, I've been thinking about how to value XRP with this whole ecological economics mindset. And I kind of got somewhere and then I got kind of stuck. And then I started seeing, especially the interview that you did with Matt, when he said the word, or when he got to the idea that the pure straight value of a volume calculation would have to be a completely instantaneous, all of the money transferred once. That's really when the penny dropped. So yeah, I'm glad that you guys have been making this discussion public because also without it, I wouldn't have anyone to present to, You'd be surprised how difficult it is to get people to watch scientific content if you don't already have a following.
All right, well, introduce us to the concept that you have put together. Where do we start?
Yeah, so I'm gonna break it down into three parts: the analogy, which the model is based on, then sort of fundamental price calculation, and then how I apply that price calculation in like a prediction kind of scenario. So the fundamental analogy, I've jotted down these few points. The value that flows through the system, through the ledger crypto exchange system, is kind of like water. And obviously there's no accident. It's no accident that there's so much water symbolism around Ripple and all these kind of things. Because water is a universal solvent, right? So anything can dissolve in it. And in that way, it's similar to the ledger, the XRP ledger, because the XRP ledger can actually capture any asset, right? The payment rails in that system, the payment rails of the real world, are kind of analogous to the pipes, right? We always hear Ripple are replumbing the finance system and all these kinds of things. And then the amount of piping that's available to move this water, that's kind of analogous to the XRP circulating supply. So just leaving the escrow out of the question and just focusing on what's been released, which obviously includes actively trading and then holding XRP, right? Okay. And then this is where it really gets interesting for me. The diameter of the pipe is actually what the XRP price is. And now you've got to imagine that this pipe is made of some kind of special material that can elastically expand and contract to meet the water flow needs, or in this case, the volume needs, right, of the value and the XRP tokens that's being transferred through the network. So in that way, it's very much like a throughput by capacity kind of model, where we're really focusing on active value that is being transferred by active volume or active XRP tokens. in the bridge currency scenario for that. But I think this model could also apply to many other kinds of crypto tokens. But obviously, it makes it especially applicable because the XRP ledger is really fast, you know. So the two fundamental principles that go into the price calculation formula that I've derived is two very simple ideas. It's this idea of active versus inactive capital components. So we need to think about the correct quantities, because only the quantities that are being traded at any given instant are actually forcing that diameter to expand or contract. So essentially changing the price, right? And that's governed by classic supply demand kind of scenarios. And then scaling, and then the second concept is to scale that whole interaction, that whole calculation down to a per instant moment. So I've used seconds in my case, but as long as you have same data for the same time period, so daily value traded over daily XP token volume, then the division calculation will reduce that quantity to an instantaneous value. But yeah, I've used seconds because I think seconds is very applicable to what the XRP ledger can do. And ultimately, in this model, somewhere between the flow rate and the diameter of the pipe, that's kind of what represents price. And you can see from this from these two images that I've got, especially the image on the left, the active component of capital that trades versus the inactive component that just sits there, you know, being held or whatever. It's actually, the active component is very, very small compared to the inactive component. I think it's possible that in the future we may see that active component in fact expand, and that touches on the whole idea of Jevons paradox, you know, which is where you could have you build something to optimize a system to make it cheaper to run, and then because it runs so quickly, people just use it exponentially, right? I really think that has applicability to what this technology is. So let's move on to some of the hardcore maths, right? So the bottom line is we're looking at the overall calculation space that we're looking at is this value per volume calculation, right? And that's where initially I got the ideas from, you know, just basic calculations of X amount of money divided by 50,000 circulating, 50 billion, sorry, circulating supply. And in principle, intuitively, that is correct. It's just that you need to apply corrections because that's like that represents an upper limit, like a maximum potential. So we need to scale that down to a more realized as opposed to a potential value. So I got some data. I'll just show you the data sources just for now. There's an article from 2019 where Bloomberg estimated that there's about $6 trillion FX traded per day. I'm just going to work with that value. Obviously, we don't know how much the XRP ledger is really going to onboard. That's debatable, and it could be a slow ramping up process, but 6 trillion is a realistic estimate of what the world really does. And then for some other calculations, I got some data from CoinMarketCap from the 4th of February. Made sure to screenshot it because it's kind of difficult to find this stuff a few days down the line, exactly as it was in a particular instant. So if we take the 6.6 trillion traded daily and you divide that then by the amount of seconds per day, you get a value of 76 million US dollars traded per day, right? If you then do the same, looking at the volume of XRP, so looking at the amount of XRP tokens that was transferred in a day, it's about, what's that, 1.8 billion, right? So you divide that by the amount of seconds in a day, and you get about 21,000 XRP traded per second. And you simply divide those two against one another, and you get down to a value of about $3,541, right? That would be the price. That is assuming that the amount of XRP traded stays the same. And that's one of the variables that could change, because as the price increases, people might sell, and then the supply would likely increase and ultimately dilute the amount of value being transferred by each individual token, therefore lowering the price. So I then used that basic idea to derive a formula, and I did a little bit of formula playing around with. I'm not going to go into super detail, but essentially I derived the formula in terms of the top here, the numerator is the value, and the denominator is this volume, is all the volume data. The X in this calculation refers to the total potential assets. The A is actually the ratio between the active to inactive components, right? So you calculate the ratio simply by taking, for example, up here, the FX traded daily divided by the total value on Earth, for argument. I've used 5 quadrillion as an example. That gives you a ratio. If you were to convert that to percent, it's about 13%. That's roughly how efficient today's markets are on a daily basis, right? So the reason I wanted to focus on the ratio calculation, you'll see for the prediction later, because that gives us a value that we can tweak. So, and then for the denominator of the formula, I've calculated the C, or I've taken C as the circulating supply. That represents the total amount of XRP released, not in escrow, multiplied by, according to the same idea as the numerator, just a ratio for what's actually trading. So you calculate that by taking the amount of tokens traded on a daily basis, that 1.8 billion, divided by the total circulating supply, it gives you 0.03. And that ratio, once again, is just done so we can create the active inactive quantities later. That's where the supply demand assumptions come in. Anyways, both of those are actually then divided by the time component. Now, in this example, I'm using the same amount of seconds. So actually the seconds would cancel out when you do the math. But the reason I've left that TA and TB in, the A obviously refers to the time period for the value being traded. The TB refers to the time period for the tokens, the things carrying the value being traded. I've just left those in because if they are different, you would need to scale them differently. So you can't, if you're using 24-hour data and 24-hour data, that's okay. But if you're using 24-hour data and you only have maybe 6 hours of data or 5 hours of data on the other side, you would need to scale this differently. And having different T values in there allows you to do that. And so I wanted to then test, does this idea work? Because I'm a scientist, everything is about testing. Everything is about validating ground truthing. So coin market cap, and I found, okay, there was about $700 million transferred over over XRP from the 3rd to the 4th of February. All right, that's just if you look at coin market cap data and you go to the volume over 24 hours, that's the 700 million there, and underneath it is basically how many tokens carried that value also over a 24-hour period. So I simply did the same thing. I could have just divided the one straight to the other, but I decided to put in the seconds to really emphasize that the period is important. The time component for each side of this, for the numerator and for the denominator, are both important. And lo and behold, it correctly predicts what the price was on that day, 0.4096. It says 4092, but that's because we've got some rounding errors here and there, because
that's pretty close.
Be due to the fact that it's pretty close. It might be a bit more of a concern if you start scaling things up, so that would be something to test at higher values too. But I'm quite happy with that, and I'm pretty sure it's down to rounding errors, because when I've taken values directly from CoinMarketCap where the zeros are, where all the points beyond the decimal place are not actually reported, so there's a rounding error. Okay, so I'm happy with it that this formula actually produces the current price if I feed it current data. So I know that the formula is reliable. So then this is getting a little bit towards the model tweaking. Okay, let me move to the next before we go to the model tweaking prediction. We can also apply the market cap data. So if we look at this formula, this is why I included the X and the C values for the total assets, the market cap, and the C, which is obviously the circulating supply. You can derive the ratio quite simply by taking the 24-hour value traded divided by the total market cap. That's the total potential. So basically the difference between those would be the inactive component of the assets. So by calculating the ratio, by taking the smaller value over the bigger value, essentially, we focus on that active component that's represented by the smaller value. And I do the same thing with the ratio B, right? And I just want to check if my assumption that X does represent market cap is accurate, and yes, we get the same price. So I know that that's an accurate variable to use for the estimate of total assets. Obviously, this is now based on current data. We are more interested in what the projections look like. That's where we start making assumptions here and there. But this at least shows us that when we use this formula based on current data, current market cap, trying to decipher active from inactive. So then the third step, and I'll get into a bit more now. And I think my internet connection got okay.
I could hear you though. It's okay.
So all right. So the third step is now ratios, and that's why I really focused on making the formulas reflect ratio that we can tweak. And it's kind of a nice thing to tweak a ratio because it scales between 0 and the upper limit that we set by the market cap or the total circulating supply, the X and C terms, respectively. So the first thing I try to do is to estimate something of a maximum realistic model, right? So what I said to myself, okay, let's take this efficiency or trading of 0.13% and let's bump it up to 3% FX of global assets per day, right? Okay. So then I imagined that let's assume that we have a roughly circulating supply carrying that value of 3% FX per day of about 62% of the circulating supply per day. All right. Now the reason I chose 60% is because I can assume that as more XRP become available, basically become readily trading or move from illiquid to liquid, slowly that will start increasing slower and slower and slower, because you'll start getting this competitive dynamic start playing out in the market, where you've got people that want to hold on to it, they don't want to sell it because they want to hold it, or they've got businesses that they have use cases for that they need the token for, and they don't want to let go of it so they can make sure their business can run, right? So you start getting these competitive market dynamics starting to play out, and that's basically modeled by a saturation curve, or what they would call a rarefaction curve. We'll get into that in a bit more detail. But that's I assumed that's 60%. We could assume it could be anywhere else, but the point is there's a kind of hard cap, and that's ultimately because the total supply in general is capped, and that's obviously one of crypto's strengths versus any other kind of monetary policy. And so if I apply those values to the same idea of total assets of 5 quadrillion, then the token price goes up about $4,700. So that's basically we've had an increase in FX activity with a concomitant increase in supply. So we're starting to look at how the supply and the demand is playing out in the price. And so this is now where we start getting to the prediction side of things, okay? These two curves for ratio A and ratio B basically represent the amount of FX activity versus the amount of XRP supply. And the curve on the left, I've modeled an exponential curve because demand is always more infinite, or is infinite compared to supply. In this case, the supply is capped, and so you start seeing that hard cap play out as this saturation curve, the rarefaction curve, begins to plateau. And this is just so what I did is I plotted curves according to the formulas that are well known for exponential curves, and then I read off the Y values from those curves. And just take a note, the X values for these curves are basically something like it would represent market state or market conditions at state 1, at state 2, at state 3, as this curve progresses. So it's not really, to think of it as time is a mistake. That's all I want to say. I know we have a tendency to see these line graphs in a sort of time series fashion. And so basically, I read off the Y values and then took those as my ratios. And I set the parameters of the equation such that they would make sense with respect to the circulating supply. And you can basically then combine those two models using the price formula, because I've modeled ratio A and I've modeled ratio B. And so we can combine those with the value over volume calculation. And you get a very interesting, like a composite curve, what they would refer to as a polynomial curve. It's got many different kinds of bends to it. And what this curve is showing, this is now showing the actual price predictions given these supply and or demand and supply dynamics. And what's cool about it is that these curves are not limited to looking like this. We could make these curves look any way we want. We could use something outside of exponential rarefaction curves. We could use linear curves, of course. And what I'd really like to do is to try and find a tool that I can just draw a random curve, and then you could apply potentially machine learning algorithms to actually learn what the past behavior did, and then to project in the future with a bit more fidelity than just using a sort of basic mathematical function, which is what exponential and saturation curves are about. So you can basically combine the supply and demand dynamics using the formula for value over volume, which we know the value over volume formula works. So then all this price prediction comes down to is how good are our assumptions of the supply and demand dynamics. And I find that quite useful because it's really a very simple approach to how do we model this thing, utility, right? And so this graph, this is now where we start to get into potential risk. This graph is showing at time, let me scroll down, at time 1, imagining an onboard of $6 trillion value FX daily on the ledger in the presence of...
Could you zoom in on that a little?
Yes, let's do that. And so this graph, so this graph is basically showing the assumptions that we've plugged into it, which are that 6.6 trillion gets onboarded to the ledger daily FX in the presence of 2.2 billion XRP tokens. All right. Now that's kind of that would be the sort of big bang scenario where out of nowhere, no one's expecting it, and suddenly this massive amount of value gets on. Who knows if that might happen? It might happen slow. We can also model for that. But for this particular graph, that's what we're modeling. And the thing is, 2.2 billion of the total circulating supply is very little. So what you would naturally expect, massive price increase, people would begin to sell, right? People would begin to cash out of the ecosystem. And that's then where we say, okay, we've gone from 6 trillion, now we increase that to 9 trillion FX trading daily, because we assume that it's still growing, the activity on the network. But now suddenly there's been this massive event of retail selling about 9 billion tokens. And now instead of 2 billion tokens carrying that value, we've got 11 billion tokens carrying that value. And so the price drops to meet that supply-demand balance. And that's where we go from about a 3,000 to, I think, that's actually about an $800 XRP, all right? And then beyond that, we start seeing only the exponential curve start taking over. So in the beginning, if you imagine these two curves at once, the beginning of our composite curve is dominated by the supply curve because that's the one that changes the most, has the most impact. And then slowly the exponential occurs. And then once this exponential graph starts to really take off, we don't really see much more change in the available in the XRP becoming readily available, becoming traded. And so then we would start to see in our chart, in our price prediction, we would start to see a much greater increase in price. So this is then assuming we've got about 100 trillion daily FX. So that's about a 10x from where the dump happened. And then we've got 30 billion, so an additional 20 billion tokens. But because of the massive increase in demand relative now to the supply, it's only 20 billion increase, whereas the FX trading is a much greater percentage increase. Then we would see the price start to take off. And at this point is really where the sort of energy from the supply competition starts to kind of run out to suppress the price because we've hit that hard cap. Once you hit that hard cap, you can't introduce more tokens into the system to carry more value. That's when you get the pipe analogy, the diameter being forced to expand. And that's really one of the great things I like about crypto in general, but especially XRP because it's so fast. So that expansion can actually happen. If you think of a slower network, that the transaction time would actually force a false expansion, kind of like a blockage, actually, if you're thinking about pipes. And so we looked at this and we thought, okay, well, that means there's actually a real material risk of significant dumpage happening if the price was to increase because of some kind of massive spike in activity. Say the central banks really do all start using it at once, SWIFT starts transferring money, that kind of thing. We can expect a humongous decrease in price. And that's fine in crypto land. I mean, we've kind of grown very battle hardened when it comes to dealing with these price corrections. But, if we have businesses, banks, central banks, and all these kind of entities, maybe even national economies at some point, they can't handle that kind of volatility for two reasons. If they're holding the token, obviously their balance sheet value decreases, which can have all kinds of knock-on effects. But the other thing which is important to understand is that if the token value decreases, you also decrease the overall liquidity of the network, which actually does impact the amount of FX transfers that can happen. Like one of the big reasons that Ripple can't do much more business than they have today is because the liquidity is kind of limited by the price. So kind of a bit of a chicken and egg scenario, but that's one of the reasons why central banks and governments, they don't want price volatility. That's why treasury bonds are typically very, very stable assets, because they kind of form a very bedrock layer in an economy. And you can't have your bedrock made of sand, right? So anyways, we took this model and I decided I want to be able to play with this thing a lot more. So I decided, let's build in sliders so we can modify these ratios and really get stuck in and tweak them. So essentially there's two, let me see if I can do that over there. Yeah. There's two panels we can play with, and there's two components in each panel. There's the supply panel and the demand panel. Each of them has a sort of y-axis extent, which this just increases this sort of basic magnitude. If we take the supply and go from low to high, you see the supply curve will essentially, you can look at the numbers changing, right? There's fewer zeros behind the commas. So that means the supply is getting larger. And then we can also change the actual shape of the curve. So we can make it a very slow selling off, or this actually approximates basically a no selling model. So we've got a massively rapid increase, but from a tiny change in tokens. We can do the same with the demand. We can say demand is very low or demand is very high, and that increases more exponentially. And obviously these functions, there's a lot of room to play around with these functions. So let's just walk through a bit of an example. I made sure to make this understandable. If you look at these values, these are the actual US dollar values or token number values on the right-hand side that these tweaks in the predictions would produce. That allows us to set things up in a nice way. So let me run through a few scenarios. Let's assume a very linear growth, basically. So, we're on board, let's move it up to about, the example I had was about 7 billion. So that's 5 billion. So I'm looking at this value under the FX daily, that's the start. And then and then below there's the FX value at the end of the 100 market states along the x-axis, those 100 market states there. And then I've divided them into the amount of change for every 20 states. So we can see basically it started at, for this one, it predicts that the FX, or this assumption, shall I say, is that the FX starts at about 5. That's 5 billion. And then it increases by 100 million, and then 114 million, and then 116, 118. And overall, from 1 to 0, there's an increase of about, I haven't split that number out. Big number anyways. I hate reading long numbers. And at the end, the value would be, through all of those accumulations of FX, the end value would be around 6 billion there. So that's assuming a relatively constant growth. Obviously, if I increase the curve of the exponential, you'll see that end value shoot up. And so that's one thing we can try and model. We can even lower the total extent to be more comparable to what the ledger is trading today. This is about 400 million. The ledger is today about $800 million per day. So let's go back to that 7 billion. That's about, and keep the linear growth curve or near linear. That's millions. Look at that's actually into the trillions there. So there's about 300 billions. And I want to scale that down to, well, let's call it 900 for argument's sake. So now suddenly we've got this massive onboarding of $900 billion onto the XRP ledger, which is roughly, I think, a 9x from where it is today, in the presence of basically relatively static growth. So moving up to $1 trillion by the end of the 100 years. States, sorry, not years. Please don't. Yeah. Okay. And then we need to deal with the supply side. So this is assuming essentially no dumpage, but that's unrealistic because if the token was to shoot up that much, we would definitely see some kind of supply dump. So let's just pick that curve, for example. And in this case, we're starting with 30 billion trading. So I'm going to scale that back to more to where it is today. So then we scale that down. How much trading today? About 2 billion, right? So let's start this model at 2 billion. So today's market. So basically what that predicts, well, 2.9 billion. There's about 2 billion. What this predicts is that if the amount of XRP that is currently liquid and trading daily was to remain the same in the presence of suddenly 900 billion, the token price would shoot up to about $479. But then, because we've got this curve, the supply curve built in it, you see the supply increases rapidly. So it moves very quickly from that 2 billion. It then moves to 9 billion and then 10 billion. So that jump from 2 to 9 billion is very, very rapid selling, right? And I've indicated it's about 7 billion tokens that get sold. That's represented by this part of the curve. What you would then see is a massive dump in price. And it would dump down to, by about state 31, which would be here, it would dump to about $100. So there we started at nearly $500 and we dumped to about $100. That is a significant risk. And this is the problem with anything economics. Everything balances out in the end, even in nature and ecology. Everything has its balance somewhere. Nature's messy and so is economics, but it balances somewhere. And so this rebalancing, if there are people relying on this token price, that could be a serious problem. You can also then expand these scenarios in various ways according to any set of assumptions, but the real meat and potatoes is in which kind of curve you use. So using an even slower deposit rate, using perhaps even more onboarding, and that sends the token up really high, you know, with, what would that be, about $6 trillion, right? Then we get into the very, very large numbers. I'm not going to go into too much detail there. This is kind of where I want to now touch base with the whole buyback discussion, okay? So ostensibly, there's actually four main risks. I've made notes here. Let me get my, yeah. So if we were to see this kind of massive onboarding followed by massive retail dumpage, it obviously also depends on how many tokens are actually in retail's hands, because perhaps they can't dump up to 10 billion tokens. Perhaps they're only holding 5 billion, you know? So there's a bit of an argument to be made for maybe that's another reason the SEC case might have happened and is dragging out for so long. The great shakeout, as people are getting to know it, because you want to only have the diamond hands when things get exciting, because they won't sell immediately and crash the ecosystem. Speculation, I don't know. But the bottom line is any kind of decrease like that would affect businesses, banks, central banks, potentially nation state economies, potentially in massive ways, due to either holdings or decreased amount of liquidity. Because if you imagine this price is decreased about fivefold in this case, so that would actually limit the amount of payments you can make at any given instant by probably about fivefold. So that's kind of a hard cap on how much business the ODL and Ripple and any XRP L business can do. So that's a problem. That's why we need price stability. And that's really what the mandate of central banks has become, is to maintain price stability. So how do we prevent that kind of mass dumpage? I can see four possibilities, right? The first is, if you were to have, if I can illustrate this, if you were to have such massive increase in demand, let's just lower the total supply, no, increase the total supply, as if suddenly 2 billion gets activated with ODL corridors to now suddenly bump it up to 30 billion to carry the massive demand. If the demand really increases in a very significant way, like we're talking big money, then the dump will be so small it's not going to matter. Here, in this case, the dump will be from 3,000 to, well, 1,500, 1,100. It's still not good. So there is still a dump, but it pales in comparison to the potential growth, right? So this model is also limited in that way because this exponential curve necessarily only increases towards the end. If you were to have a complete linear curve, then you probably, then you'd have, yeah. Anyways, one way to avoid the dumpage is basically for the demand to meet the massive supply flood. That's hard to control for, because it's very hard to predict how much business is going on. I mean, if there really is a lot of deals going on behind the scenes, then maybe that will happen. I can't speculate on that because I got no data on that. Other way is to just prevent retail from selling, right? Or maybe limit them to selling 2 billion. Once again, incredibly difficult to control. With the kind of institutional contracts that Ripple may have negotiated here and there, they've got these no selling clauses. You can't do that with retail holders, because they can access liquidity on the DEX or on any exchange or whatever. So you can't stop them from selling. So once again, cases 1 and 2 are really difficult to control for. So that's where this buyback starts to, for me, make a lot of sense as a kind of buy floor. Because if you were to be able to predict, given the correct assumptions, you would be able to predict the extent of the price drop. If you knew how much retail was going to sell in the presence of how much activity is going to be onboarded, then you'd be able to estimate how much of a buy floor you would need to put in to support the price from dumping, essentially buying retail's XRP. And that's partially what the buyback proposal is. That's why we really need to find what the correct price would be. So what you can imagine that would look like is something like, in this scenario, the dump would be from about 2,500, I think, down to, that's probably about 400 or something there. If you were to put in a buy floor all along this portion of the market states, and I think if I calculated it, basically it would be putting up, this is dumping 10 billion, I remember from the calculations I did. So this is dumping 10 billion from $2,500 below, right? So if you add that all together, if you were to put up a buy floor to support that and prevent this from happening, you would need to have a buy floor about $25 trillion in size. Now, only central banks or global regulators have money and liquidity to actually put an artificial price floor in to make sure that businesses and banks or whatever don't suffer from that. And that, for me, I see that as a major justification for why the buyback is a worthwhile option exploring, aside from the whole damages claim. Then the fourth option, this is really interesting for me because this has to do with I can foresee another potential way of limiting that kind of dump, where if you would have a sort of per instant management system that manages the supply and demand as it slowly ramps up. But basically, you would have an onboarding and then a concomitant amount of supply or pulling out or increasing to maintain the price. And I think that might actually be possible with the XLS30 AMM proposal that the ledger is busy looking at now, right? Because the bottom line to understand about that proposal is that the great thing about it is that it's going to be relying on ordinary people. So it really is this vision that I think David Schwartz and them have of the global pools of liquidity that anyone can contribute to. So basically, it's like the metaphor of many hands make light work. Everybody gives a little portion of liquidity to the AMM, then it can handle lots and lots of transfers, right? And so the AMM might be able to stabilize that because it's got an arbitrage trading protocol, and the whole point of arbitrage is to stabilize price. And because the AMMs will basically be decentralized and anybody can participate with them, you'd have this plural effect, this multiplication effect of lots of little elements in the system combining to stabilize the price. And I think that may be why we're starting to see the XLS30 proposals really being taken seriously. Because I can tell you, I don't think they thought of it last year. I'm sure in the works, thinking about how the XLS30 or how the AMM protocol would work. So I like that idea. And of the 4 options I've given, I would say that that's probably first prize. You know, if we could manage to reduce price instability by using an AMM with an decentralized arbitrage trading system, decentralized arbitrage trading protocol, rather, I think that's first prize. But because this is potentially massive scale, you know, we're talking banks, businesses, and things, I think it's a good idea to have a contingency plan of a price buyback, a price floor, essentially, that's calculated to an appropriate valuation of expected demand, with expected supply increase from retail or whatever. I think that's a good contingency plan to have in place, because when you're messing with systems this big, you do not want to leave anything to chance. And yeah, I think that basically covers it. That's essentially my model. So to sum it up, the core idea is about piping and a special kind of pipe that moves water, which can expand and contract, and that is reflected in the price. The core of the calculations is the value of a volume method per a period. And then if you look at the ratios of active to inactive, and you tweak those ratios with given assumptions, then you can really model supply and demand. And that's really what the XRP ledger is about. When you're talking about utility, you're talking about FX demand versus token supply, and then all the various players in the ecosystem that would be responsible for making that happen. So yeah.
Absolutely incredible. So those 2 scenarios, number 3 and number 4, do you have sort of model outputs that would reflect those? Like, how can we take those 2 concepts and sort of put some numbers to them?
It's an interesting idea. I haven't really thought about that, but what I imagine you could do, so the
price
AMM
floor,
would be
the price floor, like let's say you built this model, which you obviously did, and you're now the decision maker to decide what that price floor should be. Based on the assumptions you have, the data inputs around supply, value, all that stuff, what would you suggest that be?
the price floor.
Right.
Yeah, I mean, it all depends on what the expected demand and potential supply flood could be. But in the example I gave below, this is essentially a $2,500 price floor for about $25 trillion worth of buying. And that's in I can't remember what the parameters were, but it's a 10 billion token dumpage. Okay. But all the models, I will tell you a general trend I saw. Every time you play with this, and we are gonna, what I want to do is also release an online version with the valuation committee, so that people can also just play with this number one, get an understanding of how it works, get a feel for what the supply demand might look like. Then obviously also make changes, maybe use your own kind of functions. What we would like to do is also get a tool online that we can sort of trace by hand a kind of function. So then we could include that assumption of, okay, what if we get a massive increase in FX, followed by a dump, followed by a price floor, and then we'd be able to model much more complicated scenarios where we can say at this phase we've got A, this phase B, this phase C, this phase D. That's the kind of limitation when you're using simple functions like exponential curves and refraction curves. But if I am to imagine I might be able to imagine the fourth scenario, because the fourth scenario would be essentially every time you get an increase in demand, you get a concomitant increase in supply. Or when you get an increase in supply, you actually remove some supply in the corridor. So you make some of the corridor, the AMM supply, you make some of that inactive to then compensate for the extra retail supply that's coming to the system, so that it stabilizes again with the FX. So it's all about controlling supply, right? And you might be able to model that overall process, assuming it works well, with basically just a linear function. So the ratio A, which I've got down there, that's basically linear with high demand. And that would be also assuming no, you would assume some change in supply. It's a complicated scenario to try and model. I need to think about it a bit more. But that's also one of the reasons why I really want to try and get this tool out to people, because I'm one brain, right? And the lovely thing about decentralization is that, you can make the most from lots of different disparate ideas, as long as everybody's engaging, as long as a critical component of people are engaging. So there's potentially lots of scenarios that we could model with all kinds of these things. I'd really love to see what people come up with. And then they might be able to make better suggestions. First of all, on the model itself. And then if they think a massive retail dump is either a risk or not. And then if so, what could we do about it to stabilize it? And maybe they could try and model the AMM situation, or we could model an artificial buy floor, basically.
Awesome. Well, I know the team is helping to get this online tool program so that it can be shared with people who want to play around with it. And it might be fun to do something like a Twitter Spaces with anybody who wants to share their ideas with you or ask you some questions about it, so it can be a productive kind of session.
Oh, I'd love to. Yeah.
Make things better. Wow, I'm just floored. This is pretty cool.
I just want to say this, like, to anybody watching, if you have any ideas, please, my DMs and Twitter are open. Send me any ideas that you might have, any critiques. Almost like, I'm a scientist. I've been through lots of peer review. I've had lots of scathing review that I've ultimately triumphed over with a little bit of compromise here and there, whatever. So please hit me with anything you've got, because ultimately any challenge you hit me with that I can overcome, or that we can overcome, makes the model better. And that's the thing. This is not an egotistical game. It's not special that it's my model. I mean, I'm glad I came up with it, but I could care less. I want the model to be accurate. I want it to ultimately inform the XRP community, and maybe inform other businesses that might build on the XRP ledger, so that it can ultimately contribute to the growth of the ecosystem.
Awesome. All right, well, I will put your Twitter link in the description so people can follow you and message you. And everyone watching, stay tuned. I think we're going to have some more from Deon. We'll be sharing the tool, people to play with, and we'll set up something for anybody who wants to ask him questions or share some feedback as soon as we can.
Cool. Thanks a lot.
All right. Thank you. I appreciate it. Have a good day.
Same to you. Cheers.